as I had a bit of time. So just wanted to do a live session to share some of my thoughts on the current market situations and also answer some of the Q&A questions that you guys have. And of course, the last 1 week has been quite interesting. We see a lower low in the markets. Markets have dropped down a bit more again this week. And some of the questions that some of you posted, right, submitted, and those of you even you didn't, at the back of your mind, I'm sure some of you will be asking, like, should I sell now? Things are going to get worse. Seems like it's going to get worse. Why am I holding it through this period? Should I even be like continue dollar cost average? Right? How many of you have these questions at the back of your mind? Like your question is something similar. If it is, right, type yes in the chat box, or type me too. Right, so it's quite so I will cover these two main questions, right, the key questions, and after that, some of you submitted some other questions also, like right now I have too many counters, what should I do? I have 30 over stocks in my portfolio, and some of you asking about lip calls also. I have my lip calls, they are in losses right now. Should I close it? Should I roll it? What's the plan with it, right? So I'll cover these questions a bit later, but right now the key questions that I want to cover is what do we do with our portfolio right now? Right, so like there isn't a short answer for this, right? I wish I could give you a 1 sentence or like a 2-minute answer on this, but sadly there isn't. But I hope with this session perhaps can give you guys a bit more clarity on what you should do or what you prefer to do, right? So there's no right or wrong really, like what you should do with your portfolio right now. And before I begin, right, perhaps I just sum up my thoughts. So again, I'm not oblivious to what's going on out there. Like there's a lot of, like, we are heading to recession. The macros isn't looking good. Oil prices is at all-time high. It seems like it will be staying high. And we all know oil prices affect everything. And with everything that's going on right now, and again, this is not like for example, like COVID, where the Federal Reserve can just increase their, like just pump money back into the stock market to make everything go up, right? They don't have this magic button anymore, because if they do that, inflation will get even more out of control, right? So right now, it seems like things are looking really bleak, and there's no way this could, like, it seems like it's impossible that things will get better anytime soon. So with that backdrop in mind, right, some of the questions that we might have is, then why are we still holding on to these losses? Why don't we sell first, right? Sell, and then perhaps, like buy them back at a later date, right? So that is definitely a fair question to ask. But then again, right, so the way I like to see things is, the way I like to think about it is, I like to think about a few steps further out. Then, okay, I sell now, then what's next? So some of us, right, we might be thinking about this question, the immediate next step, which is I sell now, I stop. The mental loss, no more heartache, no more headache, at least temporarily. But then what's next? Like, what's my game plan if I were to sell everything now? Like, for example, let's say, hypothetical scenario, let's say my portfolio at the highs, or I started the year with 100,000, and right now maybe it's just dropped into half, 50,000, or maybe it dropped 60%. Now left only $40,000 worth. But at least I still got 40,000. So it's importantly is what I do with this 40,000 that counts. If I sell now, then I got 40,000, so I liquidate everything. Then what do I? Then what's my action plan? Like, so most of you will say buy them back later on, when things are better, when things are cheaper. So my question to you, or to people who have this thought, right, is, then what are the exact tangibles, indicators that will allow you to get back into the game? Like, is it when the news starts to get a bit better? Because we all know every single day there will be bad news in the market, every single day. Even when the markets were trending up, all-time high, there will always be bad news. So if you are like basing your decision making based on like whatever is out there in the news, right, then it might not be that good for your game plan, right? So like when we say, right, we wait for, let's say we sell now and we wait for things to like get a bit better, then like, how do you like quantify things getting a bit better? So these are just I'm not saying what is right or what is right. I'm just asking questions, and it's always good to be thinking ahead, right? So let's game out, or let's plan out this scenario if we were to sell now, right? So there's two options: one we hold, one we sell now, right? So to put it simply, like if we sell now, then what's the action plan? buy back at a cheaper price? Then when exactly will you buy back? Because let's say you sell everything now, and after you sell, great, the market continue to drop more. Another 10%, 20%, your Tesla get another 10% cheaper. Will you buy in back then? Then the news will be even worse, right? Will you be able to pull the trigger? Maybe not, right? And so how I see things, so I see this happening more often than not, right? Is like some retail investors, they will sell out and they might not buy in back, right, until the market starts to recover, right, to new highs, to a price higher than when they sold their price. So, and we all know that the market is forward-looking. Forward-looking meaning like the market will start to like go up first, and then the good news will start coming in. It's just not the other. It's not like the good news come in, then the market go up, right? And you see how this play out in the stock market over the last few months. The market start to drop first, then the bad news usually come up behind, correct? So if you are always waiting for news, like good news or bad news to make you, if you plan your action, you plan your portfolio plan or your game plan, investment plan, right, according to the news out there, then you will always be reacting to what's going on. Then there might come a possible scenario where you sell out now, let's say this week or the next following week, but then the prices start to go back up. So yeah, you miss the drop, you miss the drop, but you also miss the rebound, right? And then you might be forced to buy at when price go up. Like for example, let's say you sell now and Tesla right now is, I don't know, 650, for example. But then let's say Tesla drop a bit more, but you miss it out. And that's great, right? But as the price rebound back up to 700 plus, will you get back in at $700? So just imagine, let's say you sell now and then the price go back up. Will you buy at a higher price? Type yes or no in chat box. Right? Some of you might not. Something at the back of your mind, you might be thinking, no, I probably won't buy at a higher price. Then what if the price keep going higher? And that's just the end of it. Just nice this week you sell, and then next week Russia and Ukraine announced to truce. They settle with it, and oil prices go back to normal, and then things start to get better, and then inflation starts to taper off, right? And things slowly start to get better, right? But the price really shoot up because market is forward looking, right? By the time you react, you want to get back in, the prices already shoot up. Then will you get back in? So then investors might be forced to make these classical mistakes, which is they sell low and they buy high, right? So this is so my point is, it's not as simple as selling now and then sell now, wait for you to buy back later. Sounds like very smart in theory, but to execute this plan, right, it might not be that straightforward, right? So this is what I meant. And if you're going to be thinking about selling now, these are some of the scenarios that I think is good to be thinking about, right? So I'm not saying you should or should not, right? But I'm just sharing some of the possible scenarios that might pan out and some of the things that you might want to think about. But at the same time, right, having said that, so later I will share, of course, my own preferred approach to this and what am I personally doing. And most of you already know my own stance on this or my own bias. But at the same time, I do acknowledge that, with the current landscape, the macro situation, you might not be we don't have to be the most gung-ho approaching our portfolio or approaching the markets right now. So we can be a bit defensive. So there's a few ways to go about it. So Serene is saying there's no sound. Is the sound okay? Anyone can you guys hear me clearly? Let me know in the chat box. Is the audio okay? Okay, right. Okay. Yeah, I think it's maybe you Serene, maybe you want to unmute the sound or what. Okay, so let me go on. So there are a few things that one can do. Very soft. Is it very soft? Okay, so is the audio, the volume okay? All right, I'm not sure what's going on, but I'll just continue. All right, so there's a few things. So I was saying, there's a few things that we can do during this period also that can maybe help us to navigate through this recession or this winter. Seems like it might last a while also. So we are preparing for So the analogy here is we are preparing for longer winter. It might not be that fast to recover. It might take a few quarters, might take even 1 or 2 years out. I don't know. So there's a few things we can do here. Number one, we can hedge our portfolios. So we can do a bit of shorts. I think Chico Junior share how he was doing like synthetic shorts, right? There's a pretty good strategy. Some of you own like shares of Tesla or you can sell covered calls. You can do call spreads. So those of you who join my Patreon trading, right, I'll be sharing a bit more on some of the trading moves that I will be doing. But in short, there are a few like tactical short-term moves that one can do, right? And how much to hedge is really up to you. For example, let's say I have X amount of Tesla shares. How many covered calls do I sell? Then again, it's a question of like, how much GD I go with my nasi lemak. It's a personal preference kind of thing. But what am I saying here is there are a few shorter term approach or tactical measures that one can implement into one's portfolio also. And another thing is, when we talk about dollar cost averaging, so on my end, I'm always adding, like every time there's a new low or every time I have a new cash coming in, I'm always adding. But I do understand also, like, it might not make sense for us to keep buying this low. So maybe it would be good to visualize it out on, like how does the game plan look like. So let me share perhaps our Excel spreadsheet. All right, so can you guys see my Excel? You can just type "can" in the chat box. So let's say we start the year with, let's put some dates. February, January, we started the year, let's say, so this is a hypothetical portfolio, right? January 2022. And we started the year with 100K portfolio. And when I say we were holding true, we didn't really sell anything. And over the last 6 months or so, the market dropped, our growth companies dropped. And right now, our portfolio, instead of 100,000, is now maybe 50,000 or even worse, 40,000. So again, might be a bit more, might be less. It's just a theoretical example, right? And right now, but with 40K, right, from 100K to 40K, right, our number of shares didn't change because we are still, and we could have bought more over this period, right? So the value has dropped, but the number of shares that we own on Tesla or whatever your ETFs are did not change. Yes, so this is a key important part because we are accumulating shares. So let's say when it was 100K, we have like 100 shares of Tesla. For example, let's say it's all Tesla. And right now at 40K, it's still 100 shares of Tesla. So number of shares didn't change, but the value changed because the share price dropped, right? Quite simple. So let's say we dollar cost average in. I mean, the game plan is, you always hear like the sound investing game plan over the long term is just buy a bit every time we can, right? Regardless of the share price. So today is today is what? I would say, okay, we just use months, all right? June. Okay, June 2020. All right, and July, August, September, October, so on and so forth. And let's say, so dollar cost average, right? I mean, I covered quite a bit on that, and there's a lot of content on that, so I don't repeat. But in short, it's pretty much like you just park aside whatever you can. Let's say most of you guys are working, or you have a few different sources of income stream, and let's say you can save up, minus your expenses, you can save up a bit to buy. All right, and let's say every month you can save up a few $100s. So let's say every month you're going to deploy 500. And let's say Tesla right now is about 650. The price, Tesla share price, 650. And the price will just hover around. So I don't know how that share price will go. But let's say to have a more pessimistic view, let's say over the next few months, it just continue to drop. All right. So every month drop $100. I'm not sure how low can it go? The peak was like, but let's just say, so it might over up and down. So let's say it goes down already, then it goes up first. then come back down again, and new low, and go rebound back up to 450, because that's usually how the share price move, and then go back to 350 whatsoever. So every month, on average, right, you will buy one share, right? You just buy on average, and I mean, you might say like, yeah, I only got $500, I cannot even buy one share, right? But nowadays you can buy like fractional shares, right? And then with Tesla doing a share split, shouldn't be a problem. But anyway, this is just a hypothetical, right? So let's say every month, right, number of shares you just buy one. Of course, if you're, so this is just a, a simple example. Maybe I change this to 1,000. So it's so like there's more numerical value. So we buy 2. Maybe here buy 3, here buy 3, here buy 2. So average out, right? So the whole idea is, right, if you're invested in the best companies, you will know that this, and in the short term, right? And short term is not like 1-2 months or 1-2 weeks. Short term could be 1 or 2 years. Because when, like, let's say in a recession or when the sentiments are not looking good, the market can stay irrational for a very long time. Like long meaning like 1 or 2 years. It can stretch out quite a bit. So the fair value, so Tesla, right, as a company, right, the fundamentals continue to execute well. They continue to grow 50, 60, 70%. Their numbers keep getting better. But the share price can like go in the other direction. So the difference is getting bigger and bigger. But in the short term, the market don't care, because in the short term, like the market sentiment is just very fearful, right? But sooner or later, and this is like proven like 100% every single time, as long as the fundamentals is good, right? Sooner or later, the price have to catch up with the fundamentals. Yes. So let's say Tesla price dropped to 350, but sooner or later it will have to go back higher to new highs or the previous highs, right? And the previous highs was 1,002. So when the price flush back up, I'm not saying it will happen next month or next month. No one knows, but sooner or later it will go back up, right? And this system, right, whatever we are doing right now is on the assumption that whatever money, that remaining 40,000 that we have right now, that are in the portfolio, we don't need to touch it for the short term, because that's what long-term investing means, right? Like we don't need the money in the short term, and we don't have to worry about, we are not going to retire next month or the next 6 months, so we don't have to worry about touching this 40,000. So when the price eventually flush back up, this 40,000 will become, let's say, just say 2 years later, or maybe 3 years later, sooner or later, this 40,000 will become 100,000 again. So net, right, at the very least, right, it will go back up, and then your this 40,000 will flush back up. So in a way, if you just hold it through, there's no loss you have to make on this. But the number of shares that you buy, that you continue dollar cost average in along the way, right? So all these number of shares, let's say you over the next 6 months or 12 months, you manage to add another 20 shares worth to your portfolio, right? These shares will also go back up to the new high price, right? So from 350, you go back up to 1,000, 1,002, so and so forth, right? And then your number of shares 3 years later will become, right? So this 40,000 will become back at least 100,000, and it's still 100 shares, right? You didn't change. But over here, you added 20 new shares. And sometimes you buy a bit lower, sometimes you buy a bit higher, because we all know we cannot time the market, right? And then there's another 20K worth at least, right? So the whole idea with dollar cost averaging is like that. Like when you dollar cost average in along the way down, you are not expecting it to recover next month. You don't know when it recover, but at the very least, you don't have the assumption that it's going to recover next month. And actually, if you are really a long-term investor, you don't want the share price to recover that fast. Because if you are like a long-term investor, every month you redeploy the money. Do you want to buy the price at a high price or low price? High or low? You prefer to buy low, right? The last thing you want is after you DCA for only 3 months, the price go back up to 1,002. If the price go back up to 1,002, then your 1,000, you cannot buy 2 shares or 3 shares, so you can buy 1 share. So technically, right, you don't mind the price, the markets, right, in general, or Tesla share price to be irrational for a bit longer, because this allows you to dollar cost average at a lower price. And if you ask me, right, this is like this dollar cost averaging strategy. Firstly, we all know it's proven. I share many times why even God cannot beat dollar cost average. So this is a proven strategy. But this strategy might require some patience sometimes and requires you to handle the volatility. So every time I dollar cost average, I know that if the share price goes down, sooner or later you recover, right? And someone at the back of your mind will be asking, what if the share price don't recover? So in this case, I'm using Tesla because I have very high confidence in Tesla. But if you don't have, and again, nothing wrong, because some of us might not have the highest conviction in any of the companies, then switch your investment plan, right, from individual companies like Tesla, change it to an ETF. So like QQQ ETF, for example. And of course, you have different shares whatsoever, but the analogy sticks, right? Because QQQ or SPY is like the top 100 companies of US. And the top 100 companies will come and go, some will go bust, some will go better, but there will always be the new 100 companies. There will always be the top 100 companies in the US, and the ETF will just keep going up. So if your concern is, what if I make a mistake in choosing a company? So I have highest conviction in Tesla, but what if Tesla is a wrong bet? Sure, theoretically anything is possible. So go with an ETF direction, and that takes away the headspace also. So it's a more passive approach. You don't have to worry about company earnings. Also, you don't have to monitor the company. You don't have to worry about what Elon Musk is going to tweet next week. That could be suitable for some of you guys. So that is a more passive approach. Then again, your returns might not be as high. All right, but so it's a balance versus your own preference, risk versus reward versus do you want to go the ETF direction? That's like the play safe one, or do you want to go concentrated on a few top companies? And if you choose them right, then your returns will outperform the general market of like QQQ. But if you just want the market returns, also can compounded is also a good 10-20% year on year, right, over the long period. Right, so if you're asking, hey, what if the share price then recover? Then you change the Tesla example, or whatever is your company example, to QQQ, right? And you can do it now. Maybe only in bear markets or when shit hits the fan, like right now. Then some of you realize, hey, actually maybe I am not cut out to be individual investor. Individual meaning like I need to choose individual companies. Maybe if I just invest in like index or ETFs, also can. Your 40K worth of Tesla or individual companies after it dropped from 100K. So yeah, 60% loss, $60,000 worth, but it's still 40,000. The 40,000, right, do not know is invested in growth companies, individual companies like Tesla, or invest what? You can definitely redeploy this 40K, sell your 100 shares, and then redeploy them into buy 40K worth of SPY and QQQ or whatever, right? It's still $40,000 worth. And then you continue this example, but instead of buying Tesla, you buy QQQ. So that's one way. So this is the general dollar cost averaging. Then again, can I tweak this dollar cost averaging method, right, to be a bit more defensive? Can. Instead of dollar cost averaging every month, you do it every 2 months. So instead of doing it in June, like this month when you get a paycheck, you skip. And then because if the share price is going to be from 550 drop to 450, right, why not I wait until next month or the following month? Can. Then you stretch it out. So how do you stretch out your dollar cost averaging strategy? Instead of doing it every month, you do it every 2 months. So this will become this. Because the share price is going to drop further. So what for I go and like buy every month or every week? I stretch it out. Can also. So some of you begin to get the idea. So instead of buying at 550, if the share price drop 450, then here you buy 4 because here you buy 0. Correct? And then here you buy 0, here you buy 4. Same price. But then the next month is drop. So here, so you get the idea, right? Maybe here you can buy 5 or 6 or whatsoever, right? So you get so you can stretch it out. And if you're a bit more careful, then you stretch out a bit further. Instead of doing it every 2 months, you do it every 3 months. Instead of waiting to drop to 450, you wait for it to drop to 350, then you buy. Then your next low is maybe 250 or whatsoever. Can also. So you stretch your so in a way you add a variation to this dollar cost averaging. The general dollar cost averaging, the template is still the same, but you stretch it out such that you can buy a bit at a lower price. So you can make modification to it. So this is one way. All right. So I don't want to spend too much time on this, but so pretty much it's just I want to share like why why I'm still dollar cost averaging. And if you put it to your Excel spreadsheet, right, put your numbers onto paper, right, then you can visualize the long-term game plan better. And I guess nowadays, with how the world, is constructed, we are very short-term focused. But investing has always, especially if you invest in the stock market or equities, right, it's always a very long-term thing, right? And short-term in investing is actually at least a good 5 to 10 years out. So when you invest, right, firstly, we all know all this, right? I've covered this so many times. Like, you don't need the money for the next few years, like your next 2-3 years of operating expenses, your 吃饭钱 or whatsoever you already set aside already. And then the remaining that you don't need, you just redeploy. All right. So this recession, the worst recession that the world has ever seen, can come in the next 1-2 years. But this greatest recession ever will also come and go. Yes. So the whole idea here is you still want to be surviving after the recession, after this whole winter is over. And then make sure you don't do the things that can get you into trouble. Like Charlie Munger always say, know where you're going to die, so you don't go there. So the whole idea is you invert the thinking. How can I lose money on this strategy, on whatever I've been doing right now? What's the worst thing that can happen? What's the worst case scenario? So I don't do that. So if I know if I, buy shares on margin, or like if I'm selling puts that I don't have the capital to cover, then that could be a way that I can get my whole portfolio in trouble. So this 2-year period, right? The whole idea here is as long as you got patience and you don't do anything stupid, right? Don't break any rules, right? Keep reading the speed limit, so to speak. You will outlast this winter, right? And then you will come out of it even better. But during this 2-year period, will there be people who lose money, who burst their portfolio and then they might not be able to recover? Sure will have. And you do not want to be one of them. So that's the whole idea. So here you can see the dynamics have switched to perhaps a bit more defensive in general, right? And speaking of which, right, then let me touch on some of maybe a few other questions that some of you guys have the Q&A. So some of you, one of the question is, some of us have perhaps a lot of counters or a lot of like different names in our portfolio, 20 or 30 over companies. I feel like even a fund manager might not have that many companies. So we want to, like, if you are the one of them who have like too many counters, like 30 over companies in your portfolio right now, it's very hard to keep track of everything. So what you want to do is you want to start to work out like which are your, like really work out, like the fact that you have 30 companies also means you might not have very high conviction in any one of your companies because that's why you have 30, right? Then why not just invest in an ETF? ETF also have about 30, 40 companies, right? Just invest in ETF. Isn't it easier? Then you just switch it out. So your this 40,000 worth or whatever amount that you have. So everyone right now is sitting at a rate in losses, but you have this amount. So that amount, right, you switch it, your 30 company, Monday you sell all immediately, and then you switch it all into a ETF that also have like 30 companies or 50 companies or like QQQ, the top 100 companies. Isn't it better? It's also 40K worth. The dollar amount is still the same. So don't have to worry too much. So when you are making, when you're thinking about like redeploying your funds, right, don't worry too much about how much losses you incur on that stock. Right, the dollar value amount is still the same. Right, so don't be anchored by what we call a sunk cost bias. Right, whatever you lost in the past on a particular stock, they might have dropped 90%, 95%. It's irrelevant. It's what you do with the current fund, which is whatever amount you have. Let's say in this example is 40K, that makes the most sense. So don't be afraid to readjust. Readjust that based on, like, if you make you sleep better, there's a good adjustment also. If suddenly my portfolio is too concentrated on Tesla, but if I just shift everything to a ETF like QQQ, I'm able to sleep better. That's fine also. It's still 40K worth, all right? So do what will help you better, right? So again, if you want to choose individual companies that will outperform, right, you need to spend more time to monitor them, keeping up to date, look at their earnings and all that. So it's your choice. And you also have to be aware that you have to be comfortable that there are more volatility swings if you choose to have individual companies. And again, this is a marathon. This is not a sprint here. We are not, and I think it's fair for everyone to say, like, we are nowhere near the finishing line, right? So I'm perhaps not in this session. At a later session, I will share my own thoughts on when I feel it's the bottom. But in short, right, I feel right now that the bottom is nowhere close yet. But despite that, I continue to buy dollar cost averaging. Why? Because I shared previously, right? If you decided not to, right, then there are more questions. But if you can answer this question confidently, you have a great action plan, right? You want to stop dollar cost averaging. Okay, maybe I don't need to sell now, but I just stop dollar cost averaging and I wait for certain indicators, like objective indicators. Not like wait for things to get better, but like there's certain objective indicators that I will buy back or continue dollar cost averaging. Then that's great. So you have your own game plan, then you stick with it, right? Or you can, like in my case, my dollar cost averaging, I don't buy every month. I can stretch it a bit more so that as the market continues to drop further over the next 6 months, I buy a bit more at a lower price. You can do that too, right? So whatever you do, as long as you think it through and it's a game plan that suits you, you can stick to this game plan for a longer period. So this is not a sprint where, okay, the market is going to recover soon over the next 2 weeks or the next 2 months. I just have to tahan a bit. Hopefully, but if that's not the case, what if things continue to go sideways, the market still recover for the next 6 months and continue to just keep dropping a bit more over the next 6 months or 12 months, right? Can your game plan that whatever you have, right, is it sound enough? Is it foolproof enough to outlast this winter? Right, so that is the question that you want to perhaps use this weekend to spend a bit of time thinking about it. All right. So I have so this session I will share with you perhaps even more questions than you want answers. Right. So my gist is there isn't a short answer. Should I sell now or should I just hold and continue dollar cost average? It's really what is more suitable for you based on whatever I just covered, right? Which, like, are you leaning more towards one side? And if you choosing the let's sell now first, or let's sell a bit half, not at least half now, and buy back at a later date, right? Whatever I covered earlier, right? Please go and plan through it, right? And you feel like if that is the plan that is most viable for you, then go ahead. There isn't anything wrong. Like there is no right or wrong way. Like for example, to get fit, right? There's no right or wrong way what one should eat or should not eat. It's really up to your own preference. So right now, what I'm saying is everyone needs to understand themselves. Like firstly to even develop a plan I presented the options to you. But how do you know which one is suitable for you? You really have to ask yourself which one is more suitable for me. So for me, right, the dollar cost averaging method is proven. The maths are in my favor, history is in my favor, right? And I know it's a showing thing. But as long as I have the patience to outlast this winter, forever long it lasts, right? Then I'm in good. I will come out from it on the other end better. All right. So it's about lasting through. So I would say it's survivor mentality right now. Your game plan need to last through this period. So I see there's some questions in the chat box. So let me quickly go through them. So there's some technical questions also, like from Jonathan asks, do you recommend buy pre or post split based on past experience? The question is not so much about pre or post split thing. Like I think history has shown that I think you're asking about Tesla shares in general, or maybe Amazon or Google or whatever. Usually companies that have post split, right, they tend to do well. But it's not because of the post split per se. It's because the company is a good company and the company management knows that in the long run, based on the insider information that the company has, let's say in this case Tesla know that in the long run, perhaps the share price will go up. So therefore, they do the post split. They do the split now first. So that when the share price right now, let's say it's at 600 plus, when the market recovers, and then when the share price goes up, so it's a double move up, right? It goes up to a few $1,000. They split it down first so that it's easier. And only company share price keep going up, then need to do share split. Right? So companies that are not doing well don't even have to do share split because their share price over like the last few years just keep going sideways or keep going down. So in general, companies that have do share split, right, they tend to be doing well, like great companies, and their share price tend to be trending up over the longer term, right? So, and I would say companies doing share split is actually a bullish indicator that the company is doing well and have good prospects for the future. So Joy is asking, I have call options which I didn't close. So for call options, right, I shared even way back in January, February, and I'm sharing like now is not the time to be doing like calls or like buying calls or like dip calls. And if you're doing just portion a very, very small percentage of your portfolio. Don't overly allocate. Don't overly allocate. Right. And if you are going to do, then if you're sitting at loss, you have to be okay with taking a loss. So you see, that's where the problems come in. Like when the market drop, time to enter the leap call, then enter first. But after that, 6 months later, market never pick up. Then I go and think about what to do about it. We should start thinking about if the market is like, think about the worst case when I enter the leap call. Before I enter, I need to think about the worst case scenario. And then I need to be okay with the worst case scenario before I do the trade, right? So that's a bit of just shine the light on like a lot of decision making that we do. We don't think that far ahead, which is kind of ironic. We should, right? So before we do anything, we should have to think about the worst case scenario. In this case, buying a call option. It could be a 3-month call option or 3-year call option. But over a long-term period, what if the trade don't work out? It does work in my favor because the market goes. You see, when I buy a call option, if the share price goes up, and that's like opposite, right? That's not what I want, right? But what if it happens? What is my remedy? What is my next step of action? Right? Am I okay with taking a loss? Right. So these are some questions that one have to think about. Like if I do not know why you do a certain trade, or it's hard for me to tell you what to do with it, right? Because I don't know your thought process. But let's say if it's me, and for whatever reason, I was like in a rush, I didn't pay attention, I just did the trade. Right now, sitting at a loss, right? This is how I will approach the situation. I won't look at is it a loss or what. I will look at, you realize when I approach the markets, I approach it based on a total quantum decision making. So I see, so back to perhaps this one. So right now I'm at for 30K or 30K or whatever is the amount right now. I look at it as moving forward. I don't look at the past. It's a loss. What should I do with it? It's a decision that's anchored on the past. It's about trying to repair the losses. This $40,000 didn't know 6 months ago it was 100,000. Yes, it only knows right now it's 40,000. And moving forward, when I make my decision making, optimizing for the future. Optimizing for the future means my thought process should be like, what's the best use of this 40,000? Right now it's 40,000 or whatever the amount is. What's the best use of this 40,000 right now, moving forward? Not previously it was 100,000 or 120,000, 90% loss right now. What should I do? How should I recover my loss? That is a question that's anchored in the past. But we cannot go back to the past, right? We can only move towards the future. So our questions should be optimized our thought process for the future. So everyone, when you're asking these self questions, you try to tweak a bit. So you ask, every time you ask a question, you just say, hey, is this question optimized for the future or for the past? Right? So this will help you. So again, if I can restart this portfolio, I cannot restart back to 100,000 for sure. But right now it's 40,000. If I restart everything again, I still have 40,000. Well, how can I restart this 40,000? Monday or Tuesday when the market opens, I sell everything. I still have 40,000, right? How will I deploy this 40,000? Will I hold it in cash? Everything in cash? Will I deploy half and then the other half do like what Wei said earlier, wait for it to drop a bit more and then buy? Or what's my plan? And then what's my income revenue stream that I can deploy? Right? So these are the tangibles, right? So what are the figures that will matter? What we have right now, regardless of how much loss is it, because it's irrelevant, it's in the past. It's about how to move forward. Maybe I use a wartime analogy. You are halfway through this war, or the war is just starting. Let's say World War II or what, and you are a general, and then you are in charge of all the men under you. How many men died before? It's a tragedy or whatsoever, but you can't bring them back to life. It's what you do with the current strength that you have. How much men you have left right now, and what's the best use of it to try to win this war? Yes. So right now you have 40,000. These are your soldiers, and then incoming your reinforcement is whatever amount. So you might have a different amount. Plan it out. So these are your variables to work with, and then come out with your game plan to construct around it. So when I'm making decisions, right, I don't want to get too much into the tactical, how much I bought the call at and what. That's information, but that information might not be that relevant for your decision making. Why? Because you are making a decision for the future. So some of the questions that you might want to have is, let's say this 40,000 include some lip calls that are sitting at a deep loss right now. You want to ask yourself, if I can redeploy this 40,000 from scratch, like new piece of paper, nothing on, How will I deploy them? Will I still have this call option? Probably not, right? Because this recession looks like it will last a while. I want to be a bit defensive. Why? Like time is not exactly on our side right now, because if you're buying a call option, the time decay will kick in. I might not want to have a call option. Then sell away your call option away, because you're optimizing for future. How much loss is it? It's irrelevant. So you might lose like 3/4 of your soldiers in this battle. But if the battle is not making sense, then what do you want to do? Keep losing men in the battle? Or do you want to pull your men back so that they can be more effective in another arena? Right? So this is some not an easy question to think about. Some of us, it's very easy. Like we might get emotional away, or you might just want to block it out. We don't want to think about it. Because like taking that loss, right, is hard. That means I lost the battle. Right? I don't take that loss. But a good general will know, like, which battles to give up to save the man for the next battle that have the most influence over. Like that battle, like you lose it, never mind. But importantly, you must look at the overall 大局嘛. What's your grand strategy and how can you win the overall war, right? So okay, so let me continue. Joseph asking, is it okay to dollar cost average TQQQ? I forgot what does TQQ. Is it like a inverse or like a 2x or 3x ETF? I would say for now, right, just keep things simple. Always, why do this complicated when you can take, like, you can dollar cost average in TQQQ? There's your question. Why not just average into the vanilla ETF QQQ? You know what I mean? Like I will skew my questions to be a bit more defensive in this regard. And then follow-up question is, can we short the ETF then? So again, under hedges, I covered, right? You in the short term, there's like certain short-term moves that one can do. Like Jigen Jigen, she shared, he was doing short genetic shorts, right, on his Tesla shares. I think that's a pretty good cover. That means, or you can do like cover calls, or you can do a bit of hedges. So for me, I do like inverse hedges also. That means I find counters that are inversely related. So for example, right now, I think one of the key factors or commodities, right, that is affecting everything is oil. Because we all know oil, in everything you produce, you need oil, right? So oil prices, as long as oil prices are up, the stock market probably will have a hard time recovering. So the inverse relation, oil prices goes up, stock market goes down. And I'm in long equities here, right? So what I can do is I can have a bit of, or positions on oil. I can long oil because it's inversely weighted. Or I might not long oil, I can like sell put spreads on it or whatever. But that is a topic for another day, right? So yeah, you can do like short-term trading stuff here. So, and those of you on Patreon, I'll be sharing my own personal like inverse hedges and some of the short-term hedges that I do for this period, right? So Alice is asking, in that case, right, if our 100K worth of shares are stuck at the high price, what's the best option now? So again, the best option now is, again, back to this one, there's no one size fit all. So again, right, if I don't want to wrap up like the last 45 minutes, right, there's no one size fit all answer. I share with you like different variables, you can sell now, buy later, but then you need to follow through some questions you have to ask, or you can just hold it and then continue to hold it. You just buy a high price, but you hold it because you flush back up, right? And then along the way, how much are you going to dollar cost averaging? How exactly are you going to dollar cost averaging? For example, if you got 100 shares of Tesla, you don't have to keep adding to Tesla. You can change it to, you can add an ETF. So your dollar cost averaging, so you can own like individual companies right now, you're 40K, but your dollar cost averaging for the next 12 months, right, can be ETFs. So you see, you can mix and match. So there's it's like you buy your own Roja like that, or your own Cai Fan. You can just play around with it, whatever that suits you best. Right? And I do not know, when you ask like that, what's the best course action? I do not know your risk tolerance. I do not know your experience level. I do not know, will you be, one day, like when you are feel lack of sleep or emotion, will you panic sell and sell everything and then stop the plan, although it's working well, because you see some news that scares you. So how immune am I to like the fear news out there, or how prone am I to like panic selling everything? All these question matters also, because these are the psychology, right? And it will affect the general making decision. Every general is different. They got their own preference also. So you need to deploy your soldiers based on your own person mental lah. That means like how your risk tolerance, like are you someone that can stick to a game plan, or are you someone that cannot? There's no shame in knowing you cannot. If you know you cannot, right, then it's okay to just don't do the dollar cost averaging thing. You just set perhaps some specific indicators or tangibles, objective. For example, could be right now SPX is at 36 plus, okay? And let's say you want to wait for a lower low to buy back. So you sell everything. And then what is that lower low? SPX 334 or SPX 32 or whatever it is, you have to set, or maybe 34 buy half, 20,000 go in, and then 3,002, then buy and a half. And ask the questions that don't follow your game plan, because this is your game plan, but you make it sound as though as you sell already, the market sure will drop to these two levels for you to buy back. Or when you buy the lip call, it's like the market will go up because you buy a lip call. Ask the question that you don't want to hear one, which is after you buy the lip call, the market don't go up. Then how? After you sell already, what if the market don't drop to 3,004? It just keep going up. Possible? Theoretically possible. Then what are you going to do? So these are the questions that you need to ask. Always ask the worst case scenario question, or the questions that the game plan didn't, like your plan goes to shit, then what's next? So these are the questions that if you ask first, and write down a piece of paper, because when shit hits the fan, or when the game plan didn't go accordingly, you might forgot your rationality, or your rationality might drop, or you forgot, what was the top percent? Why did I sell everything? Now the market go up already. And what was my rationale for selling? And then I remember me say something about if the market goes up, or the market goes against whatever I was planning, right? What was my action plan? That time you think about it, you forgot already that weekend. So write it down on a piece of paper, put the date down, so that you can visualize it as and when you need it, 3 months down or 3 weeks down. Okay, so yeah, so I guess I think this session is a bit of harsh truth for some of you guys, but I think some of you guys might need it. And I always want to say, so you see, it's very easy for me to just go along with the narrative, which is what everyone is saying, which is like, oh, now everything is bad. Just perhaps sell a bit and then wait for things to get better. Everyone happy for the short term. But that might not be. So I'm giving you guys what you want. Say whatever you guys want to hear. But that might not be what you guys really need. So I hope to share a bit of like questions that some of you guys might need to think about. Maybe spend a bit of time to think about it this weekend. Right? And again, in short, right, is to wrap things up. It's really optimizing for the future. So again, your decision making, especially for beginners, it's very easy to look at, this stock, I lost so much, if I cut loss now. So you need to catch yourself. This thinking is I'm anchored in the past, some cost bias. I'm thinking about how much losses I sell, and then that will maybe prevent me from making the rational decision. Because I lost like three quarters of my platoon or my company, and so many soldiers die in this battle. But that's irrelevant already. You still have 1 quarter left. How best to deploy them? Right, moving forward, what's the best course of action? Right, so you need to really plan things out, right, and be anchored. And your decision making need to plan for the future battles to come. Not the past battle. Past battle, you lost how much, irrelevant already. Plan for the irrelevant meaning, not like your losses don't matter, but more like it doesn't matter in a decision making sense for the future. Right? So I hope you guys get this part, right? And so do your decision making over the future, for the future. Plan the scenarios that you don't want it to happen. When you do this trade or do this, you tweak your strategy. For example, I'm all in on Tesla C right now, and then it dropped 70%. But right now I'm feeling this fear, and then I want to shift everything to ETF I think easier No, I'm done with this shit. I shift everything. After I do it, Tesla shoot up because the next quarter might be a surprise for the upside, and then it shoot up a bit, but then QQQ only move up a bit, and then so Tesla outperform because after you switch out from Tesla, that's why Tesla outperform. Then what's next? Will you go and switch back in to Tesla again at a higher price, or what are the objective measurement that you will switch back in? You can always like switch to and fro, but you need to have a sound decision making, some reasoning for the decisions. Right? So you write down, if I go and switch out now, what are my like regret points? You know, like like if Tesla suddenly the next earnings is good, will I switch back regardless of the price move up maybe or not? Or will I still stick to QQQ? Because back then I realized like during the crash, I cannot handle volatility. So even Tesla should back up, but the next crash I might not be handled again. So I don't want to go through that again. So I just stick with QQQ or whatever. Right? So plan all this out. Right. So I think I will stop here. Right. I hope this session is useful. So although I said, I think it's more a lot of food for thought, right? But hopefully give you guys a bit more clarity, and like some direction for you to think about for your portfolio for the future. Right. So hope you guys find this session useful. Right. You guys, right, those of you who are still here, you find it useful, right? Let me know in the chat box. So, and also any other content that you want me to cover, let me know right now. So I can plan, and then in the next video I can cover a bit more on whatever topics you guys want to hear. All right, thank you guys. Have a great weekend. Take a bit of time this weekend to go and plan out. So have a bit of clarity. Right now, everyone is always thinking about next WhatsApp. Should I sell now? Should I don't sell? My lip caught at the loss. What should I do? You are taking the next immediate step already. So you sell now, then what? If I don't sell, I hold through my lip cost, then what? Then what's next? Will there be a case where I will sell, or I just holding it through all the way? What gives? So plan out your game plan all the way to the end game. All right. And if you're first time doing it, they've never done this before. Wow, what do you mean think about end game? I only think about next immediate step. Isn't it a good thought process to have? Then start thinking, and then as you think, other questions might pop up that you never thought of ever before in your life or in your investing journey. Then that's great, right? And then you write it down. Or any questions, right? Just ask in the group chat or PM me if I shine. Right, I will be here to help you guys as much as I can during these trying times. Right? See you guys. Have a great weekend. Bye bye.